Good morning, everybody. I'd like to welcome you all to the Daily Energy Markets Forum, where we take a look at the global oil markets and where prices, where inventories, where geopolitics is headed. And I'm delighted to be joined by three of our regular guests, Mr. Kevin Wright, Mr. Edward Bell, and Mr. Narendra Taneja. Welcome, gentlemen. Thanks for joining me this morning. Kevin, perhaps if I could start with you and just looking at one or two of the headlines there on our bulletin. Oil prices still being supported nicely by various factors, but one is that inventories in the US, we've seen another drawdown again. Your views on that? Expected? Surprised?
It's always a surprise, and good morning, sorry. It's always a surprise when you see something, of the magnitude of 5.5 or 5.3 million barrels of draw. So I think that's obviously buoyed the market a little bit today. I have to say I wait more for the DOE stats, for the EIA stats rather than the APIs, simply because I think they are a more reliable marker. But I think the 5.3 there from the API is talking about is giving the market some support this morning. I think as well, we're still seeing the effects of the Saudi cut. And I think a lot of people had expected us to be closer to the 50 than the 60. And here we are at 56.5 this morning. So that continues to surprise a little bit to the upside.
Yeah, I mean, on that, you mentioned the Saudi cuts. Edward Bell, welcome from Emirates NBD. I'll just jump to you just on that point of the Saudi unilateral cut, of course, earlier in January. Saudi made that move to obviously support prices in a new year where we had a bit of bad news in terms of rising infection rates, and perhaps the optimism that we've seen in November and December was at risk, let's say, of dampening. A few people have said in the last week or two that Saudi move, very much a temporary fix, obviously a 2-month fix. Worthwhile, really, considering that in March they're going to have to face or canceling it? I mean, was it wise?
Yeah, I think that's the big open question for at least our outlook for oil this year is that, on average, things look pretty good for 2021 as a whole, but I've got a big question mark about what happens, particularly in the second quarter. As you say, the extra cuts from Saudi Arabia are due to expire. And also, as per the terms of the OPEC Plus agreement, the additional volumes that we were supposed to have at the start of January may come onto the market at that time. So I think with that and that hanging over the market at a time when, yes, we are seeing, vaccinations being rolled out and more optimism about the outlook for growth this year, I think January, February looked pretty good for us as far as the oil market goes in terms of near-term conditions. But yeah, certainly that second quarter, we have a few questions about how strong it could be, and we could be at a risk of prices dipping back down again.
And I mean, come March, when OPEC meets again, they're obviously going to have to make that decision for the second quarter. They've already declared that they're taking a month-on-month approach to what they're going to do with production this year. And March is going to be the big decision, as you said, ahead of the second quarter. Is it possible that Saudi could continue to take the brunt of additional cuts, do you think? Is that a possibility?
I think it's a really open and critical question is how strong the OPEC Plus diplomacy will hold this year. And I think if Saudi Arabia sees that other participants are sticking to their terms of the deal, so not taking advantage of the room that Saudi Arabia has created to increase production beyond their own quota levels, then I could imagine, Saudi continuing to support the market with maybe not 1 million barrels a day of additional cuts from the second quarter onward, but perhaps doing a little bit more to make sure that the market stays in draws. I think the question, though, is they will have no control really over other producers outside of OPEC Plus. So we were already seeing talks and at least suggestions from the chair of the IEA that oil prices where they're at the moment with the WTI price in the low $50 barrel range could incentivize a return in production from fields in the United States. And that's somewhere where, OPEC Plus diplomacy, as good as it can be, has no real influence over.
Kevin, I mean, on that point of US shale and that production sort of coming back in significant amounts, we're seeing prices obviously steady in the mid 50s. A lot of people saying they could hit 60 by the third quarter, at least of this year, if not before, we're already at a price where many would argue shale can come back. Where is the shale industry today? How is it assessing prices? I mean, it's being more cautious, but what's your expectations for that if we stay in this range?
If we stay in this range, excuse me, if we stay in this range, I'd expect increased production. I think we've seen over the years, we've looked at the rig counts, we've looked at the technology improvements, we've looked at the break-even numbers, and I think if we're in the low 50s, then the vast majority of shale producers these days are able to increase production. And so I would expect that we will start to see a return to the levels that we saw, well, I guess a year and a half, 2 years ago.
And I mean, are we? Yeah, and what will OPEC do in that case, in your opinion? I mean, yes, they're talking the talk that we're all in this together, including the US, and we're conversing with the US, and we're cooperating on supporting the market together. But how will that influence OPEC's policy for the second quarter?
Yeah, it's an interesting one. I think Ed's point is right, and I've made the point myself in the past on here that OPEC has become much more proactive about how it sort of manages its output and how it manages the impacts of output on sentiment and therefore price. And I think you'd expect OPEC to continue being very cautious. You mentioned a few moments ago that the Saudi cut is only in place until March, and then there's going to have to be a decision made about whether to extend that, make it perhaps less temporary. And I expect that decision to be made with real prudence, because that's what we've seen over the last year or so. Monthly meetings rather than half-yearly meetings, in order to make sure that they're on top of what the markets are doing. And I think that would be the same situation if shale continues to increase, if US exports start to grow again. They would adjust in order to make sure that they don't effectively weaken the fledgling recovery that we've seen over the last couple of months.
Okay, Narendra Taneja, welcome from India. Thank you for joining us. Happy New Year. Let's just start with you by just talking a bit about OPEC, and then we'll go on about other Indian matters if you like. But again, India obviously a massive consumer, probably not happy that prices are being supported that much. I mean, what's your viewpoint on OPEC's policy and of pushing prices higher, at least keeping them within a certain range?
Well, I mean, look at the reality on the ground in India. Look at petrol prices, diesel prices, the highest in the last couple of years, and the result is that from media to political parties to public at large, I mean, they're all complaining when the prices are not that high, in the sense that high means in India when prices are, let's say, beyond $65 per barrel. So people can't understand why the prices are so high at petrol pumps across the country. In some places, like in Bombay, it's like extremely high, and all ordinary consumers are protesting. But when it comes to the global oil situation and all that, the main worries are basically two. Number one is that we find that OPEC is OPEC plus. We find that there's a bit of new internal realignment, and that's very big importer, since we being a very big importer. And at the same time, Biden administration worrying a little bit, in the sense that if they really are going against fossil fuels in a big way, we don't know yet. But the kind of interpretation that you hear in India, they might do that. If that happens, then India, being a large importer of oil and natural gas, is going to have a negative impact on the overall balance of payment and fiscal deficit and the economy as a whole. So there are many, many areas of worry, but as I said, we haven't reached to any conclusion yet. We are studying it very carefully and looking forward to G7 summit in London, where this issue would be raised by India, among other countries. And in the meantime, talking with Saudi Arabia and Russia both.
Yeah, and of course you have had the big burst of spike in gas prices in the last month as well. Global gas prices due to a number of factors, and I think most analysts by any accounts are expecting those to remain supported as well. So not a great time for consumers. From the economic recovery front, Narendra, in terms of recovery from COVID, impact from the pandemic, etc., give us a bit of an update about how that's going as the new year has started in terms of GDP expectations for India, the vaccine rollout. We've seen some hiccups from the suppliers of some of the vaccines, that there's going to be a delay on deliveries. Europe and the UK are arguing, for example, about who's going to get what between them. From the Indian perspective, how is that? What's the projections for demand given the current realities of the vaccination rollout in the country?
Well, when you look at the overall economy on the ground, India is doing reasonably well in the sense the demand for electricity, which is a major indicator, is back to almost 100%. Look at the demand for petrol and diesel back to almost normal. And similarly for a number of other things. If you go out in the streets of Delhi and Bombay and Bangalore, Calcutta, practically everywhere, the traffic jams are back. That's again a very big indicator in India how economy is doing. So people are back, offices are open, and in terms of vaccination campaign is very well handled. As you know, we are not dependent on imports. We are producing our own vaccines. In fact, we are rather exporting to many countries, including big countries like Brazil. So on that part is fine. But in terms of GDP, this quarter, it seems is doing better than the previous quarter. And by next quarter, things should actually be in plus in the sense that we may probably go back to 2% plus. But the next fiscal, which starts from 1st of April, situation projections are is going to be much better. And there are even projections that we might actually be back to 8 to 9% GDP, which is a very good news. Look at fundamentals. Fundamentals are very strong. Structures are very strong. N2 is more or less back. Vaccination is still everywhere, but at the same time, the fear of COVID is more or less gone, thanks to the vaccination campaign and the overall spirit of Indians. In India, we don't like to harbor, fears for too long. We are very spiritual people. So that has contributed. So we have left a lot of people, I mean, in a lighter way, a lot of people have left the fear of COVID, in the hands of God, that he will handle it. But and they have decided to go on with their normal economic life. So that's a very positive sign. And when you look at the overall policy initiatives on the part of the government, the stimulus and the activity of the company, I think situation is very much getting back to normal. But I think this quarter and the next quarter will still be under cloud. But come 1st of April, when the new fiscal starts, I think it's going to get much better. And the demand for oil is only going to grow. And we import, as you know, roughly 86% of total requirement. And my own sense is next fiscal demand for crude oil is only going to go up.
Okay, well, that's all sounding very the most positive story I've heard, really. I mean, we'll go on to China a little bit now and talk about that. But clearly, India and China both still pulling everything up in terms of consumption, obviously the oil price as the main consuming countries. But that sounds pretty positive. Kevin, Narendra was just mentioning 8-9% forecast for GDP growth this year. China, those numbers are similar numbers are being touted for China for the year ahead by certain forecasts. Again, looking the most positive region, I suppose, or country at the moment, given COVID realities. What are your views on that? Well, there's of course Chinese New Year coming up, and the government has, asked people not to travel, but there's certainly no lockdowns except for certain constituencies or communities, I believe. So, what's the forecast out in terms of impact on COVID, on travel, and on products and diesel and refined products, if you like?
Yeah. The next few weeks around Chinese New Year are going to be very interesting in terms of the way that the Earth's largest annual migratory event plays out, right? Because as you say, the government has asked people not to go home to villages, not to travel around the country, and 800 million people using public transportation, planes and trains, etc., and buses to get around. So the fact that may be somewhat curtailed this year is going to be very interesting to watch. It's
how
also
much will it impact? How much is it going to impact these 8% GDP forecasts, if you like? Does it impact that at all in terms of obviously mobility and the impact on economic activity in the country?
I think it has a short-term impact around economic activity. I think the majority of China now is out of lockdown, excuse me, out of any sort of restriction, and therefore the Chinese New Year event is a month out of 12. And therefore, the overall impact I would expect on the GDP to be limited, even if there is, a sudden slowdown in that period itself. I wanted to make a point actually that from the crude import side, we're actually still seeing very strong numbers into China in January and into February. January crude imports will look like something around 11.5 million barrels per day. February is set up to be very, very similar. And those are both significantly high, compared to the average of last year. At the same time, Chinese inventories are drawing, Chinese crude inventories are drawing. They actually reached a peak in June of last year at about 960 million barrels, and they're down at 902 as of this week. And it's actually been a relatively steady reduction all the way through the second half of last year. So when you combine crude imports and the inventory draws, that tells you that refineries are obviously running pretty hard. And that's a very good indicator for domestic demand. In fact, sorry, for domestic demand in particular, because as we know, the international markets are not nearly as buoyant, right? You've got depressed gas oil and gasoline cracks around the world, and therefore the incentive to export is not great. So all of this points to Chinese domestic consumption being pretty strong on both the gasoline and
yeah, and I mean, as you said, last year they were importing a lot and obviously storing a lot of that crude, and then we started to see consumption pick up. In terms of the price structure of things now, we've got obviously backwardation in the market rather than contango like last year. So how has that impacted the forward buying of China, obviously from a price point of view? Does it make a difference to them? Are they going to just keep buying no matter what? Prices are still quite reasonable.
Yeah, I mean, structure is only important if you hedge. And if you don't hedge, then you're just basically looking at flat price, you're looking at forecasts on flat price. And I think that's probably what China does. So contango or backwardation don't really drive those decisions. As we know, last year, March, April, May, the Chinese came out and bought a huge volume of oil across those months. That was opportunistic. That was nothing to do with structure, nothing to do with weakness at the front. It was due to the fact that prices were low and the domestic margins looked reasonable. And I think that drives the decision much more than structure does in China.
Okay, Ed, I'd like to come back to you now and talk a little bit about the macro picture for the Gulf and for the Middle East. But just before we go on to that, I want to put up our survey question. Irina, please, if we could put that up for our audience to have a look at. It's addressing actually US oil production, which we mentioned a bit at the beginning of this conversation, and the forecasts on opinion for this year. We saw production fall by 2 million barrels a day over the course of last year. So what's it going to be at the end of 2021? And the three options are there. Is it going to be to where we ended 2020 at 11, or are we going to inch back up to those 12 and 13 million barrel a day levels? So if everyone could please give us their opinion on that, and we'll come back to that and see how much we expect US production to recover. Ed, just to talk a little bit about, we've talked about China and India GDP and recovery. Gulf economies, Middle East economies. I mean, clearly OPEC and a lot of the Gulf producers within it, part of the reasoning behind their policy is to keep prices healthy so we can have some revenue into those budgets. How are Gulf budgets doing? I mean, cash flow still under pressure?
Yeah, I think, when we look at the GCC on aggregate, we're still projecting deficits across the region, given that the reliance on oil revenues is so high. But that being said, our projections for oil prices in 2021, we're expecting them to come in at an average around $50 for the Brent price. So perhaps a little bit under where the market expectations are at the moment. Nevertheless, we're going to have a slightly better picture as far as the fiscal positions go this year. I think one other thing that's driving the improvement in the fiscal positions for the GCC is actually kind of a negative in the fact that over the course of 2020 and still switching into this year, we've actually seen governments across the region pull fiscal funds out of the economy. So they're really tightening up their budgets and not adding the kind of heavy spending that we've seen some of the other developed economies take in. And even some of the stimulatory measures that we've seen have not been really direct cash ending up in the economy. They've been more indirect measures to do things like cut down on fees or lower licensing costs, those kind of measures. So they're not actually injecting any money. So what we're seeing, and we've seen a few issues so far this year, sort of a replay of what we saw across 2020, is GCC sovereigns taking advantage of still currently low interest rates to go ahead and tap the market. We had Saudi Arabia yesterday with a successful issue raising about $5 billion. And earlier this month, we've already had Oman and Bahrain coming to the market as well. So just like we saw in the last few years that more and more sovereigns have become comfortable as regular issuers, we'd expect that trend to persist over this year as well. I think we also had an interesting development in the past week where we finally had cabinet approval of a UAE debt law. So currently, the individual Emirates issue their own bonds, but we don't have a UAE nationwide bond that goes out. So that could help to shore up a bit more financing for the UAE if it chooses to go down that route.
And how much is the COVID pandemic issue kind of clouding any of these decisions in terms of expenditure or borrowing, etc.? I mean, we're here in Dubai, no lockdowns, certain restrictions, but by all intents and purposes, everything's open. And from Saudi perspective, for example, being the most significant market in the Gulf, is COVID still a concern in the Gulf? We've got the vaccine rolling out everywhere. How much is that troubling people for the sort of forward-looking few months ahead?
No, I think it is still going to be a concern, particularly for obviously the non-oil economies here in the GCC. Dubai is a very high-profile case, given it's essentially entirely reliant on its non-oil economy, and we saw a very sharp deterioration in the economy in Q2, Q3 last year before it started to bounce back. I think there is some rapid escalation in the number of cases globally that has happened this year, and what that's going to do in terms of flows of people and trade coming in and out through the regions. That is going to be a drag on the non-oil sectors. But that being said, if we have this optimism around vaccines being rolled out, there should be some kind of return to normal activity at some point this year. I think for us, though, when we're tracking the market, is seemingly markets, whether you look at it from the oil point of view, equities, fixed income markets, I think they're maybe getting a little bit ahead of where the actual reality on the ground is. So while, yes, we have the vaccine, we're still at early doors in terms of rolling these things out. So the question is, how long do we get before that return to normality actually happens? So I think everybody was pinning maybe April or May being when we get back to kind of pre-COVID kind of levels, but perhaps it could be later on in the year, and puts a lot more work on the second half of the year to try and catch up with still a pretty flat first half.
Yeah, there's certainly been some, I'd say, the last 2-3 weeks, a reality check on sort of, second half of 21 is going to be completely back to normal. And that seems to have been tempered certainly by the fact that there's been certain sort of logistical issues with some of the vaccines being distributed across the world, and also these new variants that have just surfaced, and some concern over that. If we can just staying with you for a second and just kind of going across to the US, just to get we've got an article there on the IMF talking about the stimulus plan, which obviously hasn't been passed yet, but again, looking forward to sort of US GDP for the year ahead. There you've got the IMF saying 5% if the stimulus plan is passed over 3 years, of course, albeit over 3 years. So how important is that to this region, looking across to the US GDP and where that's going and forecasts for that? And what impact is that having on thinking here in the Gulf?
Yeah, I mean, we certainly track it through the lens of how growth in the US is going to impact decisions around monetary policies. That's the sort of most direct transmission route for us here in the GCC, given the pegged economies. Now, we are optimistic about growth this year in the US compared to 2020, but I'm still in the phase of, I kind of want to see the action actually happen as far as this fiscal response. I don't think it's going to be quite as easy as markets have seemingly priced in. And we're starting to see a reflection of that already, at least as far as inflation expectations in some of the treasury markets, where we did go up to about 115 on the 10-year treasury. Now we're closer to that 1% handle. So I think people are sort of tempering or hedging their views a little bit about how big of a stimulus measure will get passed and be introduced into the U.S. economy, when it's going to happen, and also what form it's going to take. We've seen talks about the introduction of a $15 federal minimum wage, but I think there's going to be, even within the Democrat Party, some pushback and resistance against those kind of measures. That being said, it's still an economy that desperately needs the kind of fiscal support from the government under a new administration. At the meeting from the Federal Reserve, where I expect they'll be making that point again, that they're eager to work in tandem and remaining quite accommodative about growth, and that feeds well positively into us here. We don't get into a scenario like we had a few years ago in 2017, 2018, when actually we had pretty flat growth across the UAE and much of the GCC economies, but interest rates were increasing because of what was happening in the United States. So if the Fed keeps rates anchored on hold for a long period, that's still going to be beneficial for us here in the region.
Yeah, that seems to be the forecast, at least, that interest rates aren't going up anywhere anytime soon. I'd like to ask Irene to bring up the results of the question we put up earlier. And while we're looking at that, Narendra, just to go to you, just on the topic of government borrowing and issuing of bonds, and we had a lot of that in the Gulf last year, and this year the forecast is we're going to see, even more borrowing on that front. That sort of new confidence of doing that by the governments here. India, from an India perspective, in terms of debt, borrowing, etc., you painted a very positive picture earlier on about where things are going. But how is the and monetary
Good
health?
question. Well, the picture I painted was realistic in the sense that, and I'm very optimistic person, so that probably don't forget. I mean, that's also the way I'm personally looking at things. But that said, yes, I think we have the national budget coming up, within the next few days. And there are reports that the government might actually be coming out with some kind of bonds. Informally, people are calling those bonds COVID bonds. And there may be some external component as well in that bonds, which means the money being basically mobilized from markets overseas in euros or in dollars or in other hard currencies. That's very much there. The government wants to put in more money in infrastructure building and new projects and so on and so forth in order to stimulate demand. The biggest challenge we are facing in India is not so much on the supply side, it's on the demand side when it comes to economy, and especially in the rural areas and also in parts semi-urban areas. So those challenges are there, and it seems that but in order to to push demand, the government needs more money. And when you look at the fiscal deficit, when you look at inflation, things seem to be kind of under control, but it's very evident on the surface that the government needs more money. And where is that money is going to come from? So bond is one issue, or external borrowing is of course one way or another, using whichever instrument is more convenient, borrow that money. So that's very much on the card. But we will see. We will get the real picture when the budget is presented. But my own sense is that the government is going to borrow more money using different instruments, both internal and external, and at the same time, making sure that the ordinary consumers industry is not taxed any further, because that will only create more problems in terms of demand. So that there is ideas basically so that people in industry, they've got money in their hand so that they can spend. So government is encouraging individuals and companies to invest more, to spend more, so that the demand can be basically stimulated.
As is happening all over the world. No problems with governments borrowing and pumping a lot of cash into the economy for that purpose. If we can just look at the results again. Sorry, Irene, about the survey question. I wanted to look at that and just perhaps go to Kevin to close us off for today on and comment on that. Here we go. So no one thinks it's going back to 13, 20, 12%, neck and neck for the 11 and 12. We have some comments on the chat here. That actually some people were looking more at a number 10 there and expect production to drop this year even further. Kevin, your thoughts on that? You were saying earlier you think shale's looking pretty healthy at these prices. Looking forward at the price projections, do you think there's a risk of dropping below 11?
There's a very interesting comment on the chat actually that you mentioned from James McCallum, talking about how this is about recompletion of wells, which will cause a potential temporary increase rather than a long-term increase. And I think that's probably more the sort of expectation that I would have as well. I'm not talking about a huge swathe of investment into the industry. I'm talking more about taking advantage or sort of making hay while the sun shines, and that's the situation in the short term. I think Rustin Edwards also makes an interesting point about financiers not being so keen on the shale industry long term as well. So that will also cap some of that long-term increase. So yeah, I mean, my personal view on the survey was closer to the 12, but as you can see, it's fairly 44, 12. Well, yeah, that says there's not really consensus in the room at the moment.
No. And I mean, we saw a little bit of consolidation, obviously, within the shale industry last year for obvious reasons. Do you expect to see more of that this year with still pressure around there? I mean, will we see, is there room for more consolidation?
I think there's always got to be room for efficiency gains and cost reductions. And if that means consolidation, then yes, we'll see more consolidation.
Okay, Kevin, I'll let you have the last word on that. We've run out of time. Thank you very much, Kevin Wright, Edward Bell, and Narendra Taneja. Thanks for joining us, and thank you everybody for joining us. And we have there, as we brought up a poster for you, Halftime Talk interview series, a very interesting interview with the Minister of Petroleum and Resources from Egypt, which will be airing on later today at 12 o'clock. So please tune in for that. Some interesting news coming out of that as well. Thank you very much, everyone, for joining us, and we look forward to seeing you all tomorrow. Thank you.